Okay, the combined value of Australian housing has rebounded back to $10 trillion, hitting that mark for the first time in June 2022 and now again at the end of August. So why is that, and what's driving this seemingly endless growth? And here to break down the data, Anthony Landahl, Managing Director at Equilibria Finance, joins me now. Always good to have you with us, Anthony,
nice
whatever show
here.
it is that you join us for. Okay, let's talk about this 10 trillion. Huge number to get one's mind around. Okay, what is driving it?
Yeah, we've hit $10 trillion again, as you said. We hit that 14 months ago, then there was a drop in the market, and since that drop in the market in February, we've seen growth again. The main drivers of that growth, there's three main drivers that we can identify. Net migration is up, the arrivals are up, and the departures are down on COVID times when departures were around about 25% higher at that point in time. So we got up, net migration, holding up prices. A lot of people had strong savings buffers and some spare money, I guess, from sales through the COVID period. So net savings as a percentage of disposable income was around 23% through COVID. That's now down around 4%, but there's been a lot of use of savings, which has helped people fund a purchase. And the third main reason that we're seeing that is low stock, which is keeping prices up. So that's essentially helping the growth in the market and the housing market remain resilient.
Yeah, so when you were talking about those savings, that of course was a result of COVID, it's going to run out at some point. So are we seeing this 10 trillion that we're seeing, is it a normalized valuation of the market, or is this, once the savings run out, are we going to see that slow down? Well,
I think what we're seeing is on the supply side, we are seeing a little bit of extra stock come onto the market through spring. Stock levels are up around 10% through Sydney, through Brisbane, through Melbourne. What we're also seeing is demand is quite subdued. Cost of living pressures are really biting. Access to credit is biting. So consumer sentiment is down. So we are seeing a market that's got a little bit of uncertainty around it, but we've just had the 6th month of growth since February. So nationally, we're up about 4.9% in our growth since February of this year. We're seeing the main drivers of that in Sydney and Brisbane. Their growth's back up around 8 and 10% respectively. The regionals are struggling more. Potentially they got a little bit overvalued through that COVID period where a lot of people were making a tree change, I guess. So we've had our 6 month of growth. The rate of growth is a little subdued compared to prior months, but I think fundamentally we haven't seen a full rebalancing of the market. We're still seeing the increases in the capital cities, and while ever we've got a shortage of supply, which is a structural issue as much as anything, supply's down 19% on the 5-year average through spring. So the markers are shortage of supply, migration's up, whilst household savings are going down and access to credit is a little bit more difficult. I don't think there's any signs that we're going to see a market drop. It might slow down a little bit, but all signs are that we're going to keep seeing that growth.
So you do think the fundamentals are pretty strong there, like when we look at the housing market moving forward. And that said, how does this asset class compare to other investment classes if you're looking to park somewhere?
Yeah, look, I think there's two ways of looking at that. There's the return on the asset class and there's the sheer size of the asset class. Some interesting numbers around that is housing makes up 56% of our actual wealth as individuals, and housing markets at $10 trillion. By way of example, superannuation is a $3.5 trillion market. The Aussie stock market's around about $3 trillion, and commercial real estate's about $1.9 trillion. So housing is the heart and soul of an asset class for many Australians. I think we've obviously had a subdued stock market that's been challenging, and I think similarly for investors, there's been some real challenges over the last 12 to 18 months, mainly around cash flow and access to credit. So I think the main challenge facing investors right now for those with existing properties is holding those through this time where rates are higher, Inflationary pressures are impacting their cost to hold the property. So there are some investors facing some cash flow challenges. For new investors, the cost of, whilst we've got very tight rental markets and higher yields, the cost of actually accessing credit and actually accessing credit with buffer rates of 3% has been quite challenging. So the investor market as an asset class right now is remaining quite subdued, but housing as a percentage and as an asset class across the Australian consumer, it's close to 60% of our total net wealth.
Yeah, you touched on what I wanted to ask next. You said, the cost of holding on because of interest rates, and we have the RBA's next policy meeting, the first one for Michelle Bullock. So it's a big one that we were really looking forward to. What would the implications be? I think, the possibility of another hike is still there, but as far as next week goes, what is your reading and how do you think it will impact homeowners?
We've obviously had the inflationary data this week that's been talked about a lot, where the inflationary numbers were up on the prior month. However, interestingly, core inflation is heading in the right direction once the variables are taken out. That was mainly driven, interestingly, through cost of fuel and housing and food. In terms of next month, I think the RBA will probably wait until we get the quarterly inflationary data, until we get the next employment data. My intuition is there's probably going to be one more rate rise before the end of this calendar year. I don't think it'll be next month. It may be on Melbourne Cup Day, where people might have their mind on other forms of investing. But yeah, I have a feeling we will see one more rate rise. We're still running an inflation around about 5.5%. It's well above their target. Unemployment remains tight, but I think we are through the worst of the rate rises. But I do think we're going to have another one, and then there'll probably be a hold maybe for 6 to 12 months before we see any relief. Our cash flow is still well down on other sort of major economies in the Western world as well.